Very good evening to all of you. On behalf of Auditing and Assurance Standards Board of Institute of Chartered Accountant of India, I welcome you all in today's 151 CP program organized by AASP of ICI for this council year. Today, we are organizing this CP program in the form of webinar that is a very important topic, that is the materiality and going concern. And these two important topics are very important while auditing. So in order to tackle these two important topics, we are having with us eminent speaker CA Paras Chatterjee. So on behalf of AASP of ICI, I extend my warm welcome to CA Parasji. Welcome to you, Parasji.
Thank you, sir.
We are having with us CA Sagar Yadavji as a moderator for today's webinar. So on behalf of AASP of ICI, I extend my warm welcome to Sagarji to moderate this today's webinar. So in order to formally start the proceedings of the webinar, I request Sagarji to please take over the further proceedings. Over to you, Sagarji, please.
Thank you, Anilji. Good evening to everyone. Welcome to this insightful AASB ICI webinar on demystifying materiality and going concern, where we dwell into two critical concepts shaping financial reporting and auditing. The materiality guides the relevance of information in decision making, while going concern assess the entity's ability of its operational. In this webinar, we aim to demystify this principle, exploring their practical implication and evaluating evolving regulatory expectations. We have privilege to have CA Paras Chadha as our speaker. Paras Kumar Chadha is a qualified chartered accountant having more than 12 years of experience and has been working as senior manager in the financial accounting and advisory service division of EY. He has completed NDA certification course and BRSR certification course from ICAI. His core expertise lies in gap conversion, that is like from IGAP to Indian AS or IFRS or US GAAP, reviewing standalone or consolidated financial statements prepared under AS or NDS, analyzing financial statement prepared under hyperinflation economy, evaluating business combination accounting, and providing opinion on complex transactions like business combination, consolidation, financial instruments, share-based payment, revenue, leases, etc. Prior to joining EY, he worked in audit division of SR Denodia and Co. LLP, where he conducted audit of different sectors like manufacturing, service sectors, banking, and PSU. Beyond his regular responsibility, he is involved in professional activities, serving as a registered technical reviewer on the panel of Financial Reporting Review Board and Research Committee of ICAI. He is a regular committee faculty member of India's certification course, which is conducted by Accounting Standard Board on behalf of ICAI. He frequently delivered training sessions on various accounting and auditing topics such as business combination, consolidation, revenue recognition, plant property and equipment, finding of FRRB, going concern, and other standard on auditing. I welcome CA Paras Chadha to provide insightful perspective on today's topic. I welcome you, Mr. CA Paras Chadha.
Thanks, Sagar. So can we start?
Yes, please.
Okay. Please let me know, is my screen visible? Is my screen visible?
Yes, please.
Okay. So first and foremost, I would like to thank AASB team for giving me this opportunity to share my views on this particular topic. And I would also like to thank everyone who has spared the time to attend this session. So without further ado, let's get started. So as you guys can see on the screen, Our today's topic is demystifying materiality and going concern. But before starting the session, I want to give one disclaimer here, because as you guys know that these two topics are very vast, and hence it is impossible to cover all the concepts of these two topics within 2 hours. But I'll try my best to cover all the relevant concepts which may be applied in the practical life, right? So this is our agenda which we are going to discuss for next 2 hours. First one is concept of materiality, which is built by SA 320. Then next one would be going concern as per SA 570. Then we will know what is the impact of this materiality and going concern on the audit report. And in last, we will have one question answer round, right? So first one is concept of materiality. Before jumping into the definition of materiality, let me explain you the concept of materiality with the help of one simple example. Suppose you guys are conducting the audit of XYZ Limited and you have identified one error in the revenue caption, right? And this error is of 1 crore rupees, let's assume. On the other hand, you guys are also doing the audit of Reliance Industry, and again you have identified one error of 1 crore rupees in the revenue caption. Now this 1 crore rupees could be material for XYZ Limited, but it could not be material for Reliance Industries, right? And hence this is the concept which I want to explain. Materiality depends on the size of the organization and the nature of the organization as well. Now, if you will read the definition, which is given under SA 320, it states that materiality in the context of an audit is misstatements, including omissions, which could influence the economic decision of the users taken on the basis of financial statements. Means if any decision of the users can be changed due to any misstatements, including omissions, then we can call it materiality. But again, it will depend on the size of the organization, right? Now, what is the type of materiality? There are two types of materiality. First one is quantitative materiality and second one is qualitative materiality. So the example of quantitative materiality, I have already shared with you the error which you found in the revenue caption of 1 crore rupees. Now, if you talk about the qualitative materiality, let me explain you with the help of one example. Suppose there is a holding subsidiary relationship between two entities, and while preparing the financial statements, management of subsidiary company forgot to disclose the name of holding company in the related party notes, right? And here, as per the requirements of India's 24 or AS 18, whenever there is a control between holding and subsidiary, then disclosure is must in the related party notes, irrespective of the fact whether any transaction has taken place or not during the year between these group entities. So suppose you are doing the audit of, or you are the conducting of audit, you are conducting the audit of subsidiary company, and you noticed that subsidiary company didn't disclose the name of holding company in its related party notes, right? And hence this is a breach of AS1 or AS18 or India's 24, and hence such breach is required to be reported in the audit report. We can discuss one more example here. Suppose an entity is in the business of selling of liquor, right? And suppose the government has banned the sale of liquor. Now there is a question mark on the going concern of the entity, because the entity would not be able to run its operation in the future. Why? Because the government has banned the sale of liquor, and hence it becomes important for the entity to disclose such facts in the financial statement. Now here we are not discussing about any threshold limit, because we are discussing about the qualitative materiality, and hence there are two types of materiality as we have discussed. First one is quantitative materiality and second one is qualitative materiality. Now, what is the use of materiality? Auditor will use the materiality in planning and performing the audit. Next, evaluating the effect of identified misstatements and uncorrected misstatements, if any. Why I have mentioned if any, we will discuss, right? And third, or in last, forming an opinion on the financial statements basis the materiality, correct? Now, if you talk about the quantitative materiality, it has been further divided into three categories. So practically we calculate these three materiality for the purpose of planning and performing an audit. So first one is overall materiality. It is also known as planning materiality. What does it mean? It means if the aggregate of errors of all the items are more than the planning materiality, then the auditor is required to qualify the audit report. Suppose you are doing the audit of XYZ Limited and you have identified 5 errors and you have set one threshold limit, which would be your planning materiality. If aggregate of all these 5 errors exceed the threshold limit set by the auditor, then auditor will be required to qualify its audit report, right? Now, how will you calculate the materiality? So there are different benchmarks which can be used for the purpose of calculating the overall materiality. First one is turnover, second one is PBT, third one is total assets. There could be other benchmarks as well. For example, EBITDA, for example, total assets, for example, net worth. So you can consider any one of them depending upon the nature of the entity. If the motive of the entity is to increase its top line of the P&L account, means revenue from operation, then you should consider turnover as benchmark for the purpose of calculating the overall materiality, right? But on the other hand, if the objective of the entity is to increase the PBT, then profit before tax can be considered for the purpose of calculating the overall materiality. But one thing you should keep in your mind, that profit should be non-volatile. Means it should not be the case that profit is fluctuating significantly from one year to another year, correct? Suppose you are doing the audit of any NGO. Now the objective of this NGO is not to earn the profit, and hence in this case you cannot consider PBT for the purpose of calculating the overall materiality, right? So it depends on the nature of the business as well, as I said. So suppose you are doing the audit of bank, then you can consider total advances for the purpose of calculating the overall materiality. But on the other hand, suppose you are doing the audit of an insurance company. In this case, premium, that is the revenue from operation of such insurance company, should be considered for the purpose of calculating the overall materiality. So in my example, what I have done, I have assumed the main motive of the entity is to increase the top line of its P&L account, that is revenue from operation, and I have calculated the figure on the basis of turnover, right? In practical life, generally the range between 0.5% to 3% is applied on the revenue figure. Right now, when you will apply 0.5%, when you will apply 1% or 2% or 3%, it depends again lots of factors, which we will discuss in the next slide. Right. So what I have assumed that there is revenue from operation which is 1000 crore rupees, and I have applied 3%, which comes to 30 crore rupees. Now, what does it mean? It means if I am conducting the audit of an entity and I have identified misstatements, and if such misstatements are material and uncorrected, and if such misstatements exceeds 30 crore rupees, then I am going to qualify the audit report, right? If you want to apply if you want to consider the PBT as your benchmark, then practically 5% to 10% range is applied. It might be possible that your entity is under capitalization. The entity has not started its operation yet, and hence in this case you can consider the figure of total asset as well. And again, practically range between 0.5% to 3% is applied. So in my example, I have considered turnover as benchmark, and I have applied 3% on the revenue figure, and it has come 30 crore rupees. Now, overall materiality is calculated just forming an opinion, because auditor is required to provide its audit report on overall financial statement. But auditor is also required to perform its audit, right? And hence, for the purpose of conducting the audit, one more materiality is calculated, which is known as performance materiality or the tolerable error. This materiality is calculated on transaction level, account balance level, or disclosure level. For example, inventory, PP, revenue, and there could be other captions of the balance sheet and P&L as well, right? And this is the percentage, either 50% or 75% of the planning materiality is calculated. You are required to pay attention here. Here I have not mentioned any kind of range. I am saying either 50% or 75% of the planning materiality you will calculate. So what I have done, I have applied 50% over 30 crore rupees and it comes to 15 crore rupees. So what does it mean? It means the captions of the financial statements which are having balance more than 15 crore, I will apply the detailed substantive audit procedures, right? To get the comfort to obtain the audit evidence. But for account balances which are less than 15 crore, I will apply the analytical procedures and move on, right? So if you will apply the higher percentage, then less work is required to be performed, and if you will apply the less percentage, more work is required to be performed. Suppose instead of applying 50%, I had applied 75%, then this figure would have been 22.5 crore rupees, right? And if this figure would have been 22.5 crore rupees, then I was required to calculate, or sorry, I was required to apply substantive audit procedures on account balance, which are having balance more than 22.5 crore rupees, and hence less work was required to be performed. One more thing we need to keep in mind here is that in practical life, you can apply different percentage for different captions. For example, you may consider 75% for the purpose of calculating performance materiality on inventory caption. For revenue, you can consider 50%. For PP, you can consider 75%. For cash and bank balance, you can consider 50%. So I'm just giving the example, right? But for the purpose of simplicity, what I have done, I have calculated overall performance materiality, which comes to 15 crore rupees. Now, one more materiality is required to be calculated, which is commonly known as CTT, clearly trivial threshold, or summary of audit differences, that is SAD. This would be 5% of the planning materiality, and you can see here it comes to 1.50 crore rupees, 1 crore 50 lakh rupees, right? Now, what does it mean? It means if the aggregate of all the uncorrected errors is less than 1.50 crore rupees, I will ignore these errors. And hence, it is also known as non-material, hence ignored. And in short form, we call it as NMHI, right? But in contrast, if the aggregate of all the uncorrected errors is more than 1.5 crore rupees, then I need to discuss the same with the management. Then rectification entry in the financial statement should be passed because the error is more than the CTT level. And if management doesn't agree to pass the journal entries, doesn't agree to rectify these entries, then in that particular scenario, what the auditor will do? Auditor will jot down all these errors in one work paper, and this one work paper is required to be signed by the management, because auditor will put this document in its software for the purpose of documentation, right? Now, these are the factors which are required to be considered while applying the percentage. First one is number of shareholders. If there are many shareholders, then low percentage should be applied. But in contrast, if there are few shareholders, then high percentage is required to be applied. Suppose there is a listed entity and public stake is involved, so there would be lots of shareholders, and hence in this case low percentage should be applied. We are talking about this percentage, right? We are talking about this percentage. So in case of listed entity, you will apply the low percentage. In case of unlisted entity, where the family members are the directors or the promoters of the entity, in that case you can apply the high percentage. Similarly, you need to check level of traded debts, if it is high, you will apply the low percentage. If it is not high, then you will apply the high percentage, right? Then you need to consider likely to go to public within the next 2 years. It means if your company is planning to go for IPO within next 2 years, then it means public stake would be involved, and hence in this case conservative approach is required to be taken, and hence you will apply the low percentage. But in contrast, if your company is not planning to go for IPO, then you can consider the high percentage. Similarly, there could be other indicators as well. You need to check the changes in the business environment, viability of the business, external financing, and there could be other factors as well. So while calculating the benchmark, you need to consider the different factors for the purpose of calculating the overall materiality, right? Then next is impact on audit report. So as I said, if you have identified misstatements, let's assume you are conducting the audit of XYZ Limited and you have identified 5 misstatements, and you discussed the same with the management, and out of 5 misstatements, management agreed to rectify 2 misstatements. But as per the understanding of management, remaining 3 misstatements are not misstatements, correct? And hence management does not agree to rectify these remaining 3 misstatements. So what you will do in this scenario, if the aggregate of all uncorrected misstatement is, let's assume 5 crore rupees. So what you will do, since it is below performance materiality, and hence audit report will not be modified provided SAD is taken from the management. SAD is summary of audit differences. You will take the signed copy of SAD from the management for the documentation purposes, right? Let's assume if this figure is 18 crore rupees. Now our performance materiality level is 15 crore rupees, and the aggregate of all the uncorrected misstatement is 18 crore rupees. So it is less than the planning materiality but more than the performance materiality, and hence audit report may be modified depending upon the gravity of the caption, correct? And in last, if it comes to 35 crore rupees, then there is no doubt it is more than the planning materiality, and hence audit report is required to be qualified in this case. Our next topic is going concern. So what is the meaning of going concern? Going concern is a condition in which enterprise is continuing its operation for the foreseeable future. Now, this is not the definition which has been given in SA 570. This definition I have taken for the purpose to just teach you what is the concept of going concern. This standard is applicable, revised standard is applicable with effect from 1st of April 2017, and the scope of this standard is that this standard deals with the auditor's responsibility in the audit of financial statements relating to the going concern and implications for the auditor's report, right? Next one is responsibility of the management. What is the responsibility of the management? Management is responsible to ascertain the going concern assumption. The judgment about the future is based on the information available at the time at which judgment is made. If the financial statements have not been prepared on going concern basis, such facts should be appropriately disclosed in the financial statements. Now you guys will see here that this essay is saying that management is responsible to make the going concern assessment, right? Now one question arises here that standard of auditings are applicable on auditor and not on the management. Then why management would make the going concern assessment? Why the management is responsible to ascertain whether the financial statements are being prepared on going concern basis or not? So here a role of accounting standard and Indian accounting standard, that is India's, comes into the picture. If you will read para 10A of AS1, it says that one of the 3 fundamental accounting assumptions in the preparation of financial statement is going concern. So what are the 3 fundamental accounting assumptions? First one is consistency, second one is accrual, and third one is going concern. So it is AS1 which is saying that financial statement should be prepared on going concern basis, or you can say that whenever any financial statement are being prepared, then it is assumed that such financial statements have been prepared on going concern basis. And this is the definition which is given under AS1. Going concern is a condition in which enterprise is continuing its operation for the foreseeable future. An enterprise has no intention of going concern, then disclosure is required. It means negative disclosure is required. What does it mean? It means if the financial statements have not been prepared on going concern basis, then and only then disclosure is required in the financial statements. Otherwise, disclosure is not required regarding going concern. Correct? But if you will read para 25 of AS1, it says that financial statements to be prepared on going concern basis unless management either intends to liquidate the entity or to cease trading or has no realistic alternative but to do so. Means balance sheet should be prepared on going concern basis. The management shall make an assessment of entity's ability to continue as going concern. Here, Ind AS 1 is making responsible to management, that management is responsible to assess whether the entity is a going concern entity or not. And in AS 1, there is mandatory disclosure irrespective of the fact whether or not financial statements are being prepared on going concern basis. So you guys can clearly see here that there is gap difference between AS1 and Ind AS 1. AS1 says if the financial statements have not been prepared on going concern basis, only then disclosure is required. But in contrast, Ind AS 1 says that there is mandatory disclosure irrespective of the fact whether the financial statements have been prepared on going concern basis or not. Further, Ind AS 1 is saying if financial statements are not prepared on going concern basis, then management shall disclose events or conditions that cast significant doubt on entity's ability to continue as going concern and basis of the preparation of financial statements. Means if the management has agreed that financial statements have not been prepared on going concern basis, then whether such financial statements has been prepared as per the provisions of Ind AS 105, which talks about non-current asset held for sale and discontinuing operation, right? If you will read para 2 of SA 570, it is aligned with Ind AS 1, and hence I am not going to spend any time on reading para 2 of SA 570. It is similar to Ind AS 1, right? So these accounting standards and Ind AS are making responsible to management to assess whether the entity is going concern entity or not, and whether the financial statements have been prepared on going concern basis or not, right? Now we need to check when we will say there is any event or conditions that may cast significant doubt on the entity's ability to continue as going concern. So we need to discuss few indicators. So this is the balance sheet of X Limited and Y Limited as at 31st March 2024. First, we will analyze the balance sheet of X Limited, and then we will analyze the balance sheet of Y Limited. You can see here that reserve and surplus of X Limited is negative by 90 lakh rupees. So what does it mean? The company is incurring losses on year-on-year basis, and hence reserve and surplus has become negative by 90 lakh rupees. Share capital of company is positive by 50 lakh rupees, and reserve and surplus is negative by 90 lakh rupees, and hence there is negative net worth by 40 lakh rupees. Means net worth of the company has also been eroded. Further, if you will see, the total of current liability is 50 lakh rupees, and total of non-current asset and current asset is 35 lakh rupees. Now, what does it mean? It means even if your company sell all PPE and realize all current assets, then also company would not be able to repay its current liability, because current liability is the amount which is required to be repaid within a period of 12 months from the balance sheet date, right? And hence there is a clear-cut going concern issue, because the company is not able to repay its current liability even if the company sell all its PPE and realize all its current assets. One thing you need to keep in your mind, most of the people make mistakes here. What they generally do, they compare the total liability with the total assets, which should not be the case. Why? Because non-current liability is not required to be repaid within a period of 12 months, and hence it should not be considered while you are comparing the total assets with the current liability. Institute has issued one implementation guide on SA 570 in which it has clearly been stated that current liability is required to be compared with the total asset and not the total liability is required to be compared with the total asset, right? Now, if you will analyze the balance sheet of Y Limited, I don't see any kind of challenge, any kind of issue in the financial statements of Y Limited. Why? Because you can see here, the reserve and surplus is positive, net worth is positive, the current liability of the company is 30 lakh rupees and the total assets of the company is 2 crore 5 lakh rupees, means current liability is not exceeding total assets, and hence there is no issue, there is no indicator of any significant any condition or event which may cause significant doubt on entity's ability to continue as going concern, right? Now the standard has given three indicators. First one is financial indicator, second one is operating indicator, and third one is other indicator. And now we are going to discuss all these indicators one by one. Under financial indicator category, there are few examples. First one is net current liability position. This example we have already discussed in my previous slide, so I'm going to skip it. Second, no realistic prospects of repayment of borrowing. Suppose there is due date of repayment of borrowing, but the company is facing financial crisis and hence the company is not able to repay its debt, whether it is interest or principal or both on the due date. So it might be the financial indicator, correct? Third is excessive reliance on short-term borrowing. The company is not carrying a good image in the market. The CIBIL score of the company has been decreased significantly, and hence no one is ready to provide fund to the organization, to the entity for long-term purposes, and hence company has started to place reliance on short-term borrowings even for long-term projects, right? Next one is withdrawal of financial support by creditors. Earlier, creditors were allowing the entity a credit period of 45 days, 60 days, or 90 days, depending upon the negotiations between the entity and the suppliers. But now the creditors are saying, if you pay the amount immediately after supplying the material, then and only then we will supply the goods, otherwise we won't. Next one is negative operating cash flows. So you guys must have seen the cash flow statement, and there are three activities in the cash flow statement. First one is cash flow from operating activities, second one is financing activities, and third one is investing activities. So if there is negative operating cash flow, then this is one of the indicator that the company may face going concern issue. Why? Because the company is not able to maintain its working capital requirement, right? And hence there is a issue of negative operating cash flows. Next one is adverse financial ratios. Current ratio of the company is not good. EPS is negative, net profit ratio is negative, and hence these are the financial indicators which are casting doubt on the entity's ability to continue in the foreseeable future. I am not saying that the company would not be able to survive in the foreseeable future. Why? Because mitigation plan could be available with the entity, but material uncertainty exists in the financial statement of organization. Then next is substantial operating losses. So if you prepare the trading account of any entity and you find that there is gross loss, it is a clear-cut indication of going concern issue. Why? Because your company is not able, your organization not able to even earn the gross profit, and hence how can you expect that your company would be able to survive in the future, correct? So again, this is the financial indicator. Next one is areas of dividend. Now, it might be possible that company has not declared dividend for several years, or the company has declared the dividend, but it has not paid the same to the shareholders. And hence, again, it is one of the financial indicator regarding the going concern issue. Next one is inability to pay creditors on due date. This we have discussed. Inability to comply with loan terms. This we have discussed. Changes from credit to COD with suppliers. This we have discussed. Inability to obtain financing for essential products. Now, as I said, your company is not carrying a good image in the market, or CIBIL score has been decreased significantly, and hence no one is ready to provide financing to the company, even for its essential products, right? So all these are the examples of financial indicators. Now we are going to discuss operating indicators. Under operating indicators, the company is not facing any kind of financial crisis, but still there may be chances that the company would not be able to survive its business in the future. The company would not be able to continue its business in the foreseeable future. So first example under operating indicator category is intention to liquidate the entity. Now, if the management has the intention to liquidate the entity, this is the clear-cut operating indicator that the company is not going to continue its business in the foreseeable future, right? Second one is loss of key management without replacement. So let me explain you with the help of one example. Suppose I am running a manufacturing entity, right? And for this purpose, I have hired one plant head. Now this plant head is doing his job very well, and the defect rate in the product is, let's assume, 0.5%, right? Now this plant head has gotten another opportunity and he has joined another organization, and I am not able to find any replacement of such plant head, and hence the defect rate in my product has been increased from 0.5% to 5% on 10% or 10%, let's assume, right? Now my product is not carrying such a good image in the market as it used to carry, and my sale has started to decrease. So it might be possible that I may face going concern issue in the future because my sale is decreasing day by day. Now you can analyze here, there is no financial indicator, there is no any financial crisis in the organization. Still the company may face going concern issue. So these are the examples of operating indicators. Next one is workers difficulty. Suppose the entity is not able to find the labor, or the workers are on strike. Workers are saying हमारी मांगे पूरी करो तभी हम काम करेंगे. And if workers are not manufacturing the finished goods, how the company or how the entity would be able to sell these products in the market, and hence the organization or the entity or the company may face going concern issue. Next one is shortage of important supplies. The raw material which is required to produce the finished goods is not available in the market, and if the raw material is not available in the market, how can any organization produce or manufacture its finished goods? And again, this is the operating indicator due to which the company may face going concern issue. Next one is emergence of highly successful competitors. So best example of this category is Jio. When Jio came into the picture couple of years back, many small telecommunication entities like Tata Docomo, Aircel, Idea had exited from the market, and hence this is the example of operating indicators. Next one is loss of key customer, franchisee, etc. So if you guys might have done the audit of OEM, original equipment manufacturer, then you must have noticed that there is only one or two customer of the OEM, right? Suppose I am running a manufacturing entity and I am the original equipment manufacturer, and I sell my goods to Maruti only. So Maruti is key customer for me. Now Maruti has identified defect in my product, and Maruti has sent me several reminders that you need to improve the quality of your product. And despite receiving several reminders, I am not improving the quality of my product, and as a result, Maruti has cancelled all the orders with me. Now Maruti was the only customer for me, and if I have lost the customer, how I would be able to survive in the market, right? So this is the example of key customer. Now let's discuss the example of loss of key franchisee. Suppose I am running a MACD outlet, right? I am running a MACD outlet, and the quality of my product is as per the quality norms of MACD. But there is one issue. My staff is not wearing the uniform of MACD, and the design of my outlet is not as per the MACD. Now, you guys must have visited many outlets like MACD, Pizza Hut, Domino's, Bikaner Wala, Haldiram, or any other outlet. And you must have noticed that the uniform of the staff is same. The design and specification of the outlet is same, right? And hence there was a surprise visit by the HO, and HO noticed that my staff is not wearing the uniform of MACD, and hence they have cancelled the license. And if they have cancelled the license, my sale will start to decrease. Why? Because most of the customers were coming into my outlet due to brand name of MACD, right? So this is the example of operating indicator. Next one is loss of major market. So 2 decades before, we all were using Nokia featured phone, right? But when Google came with its Android software and wanted to shake hand with the Nokia denied this opportunity. But Samsung immediately grabbed this opportunity, and result is in front of you. Now no one is using Nokia featured phone. So this is the example of loss of major market, right? Next category is other indicator. This is not the these are not the financial indicators and operating indicators, but there may be possibility that the company may still face going concern issue. What are the examples? First one is non-compliance with capital or other statutory requirements. There is Insurance Act 1938, which requires that every insurance company is required to maintain minimum capital base. For example, let's assume 100 crore rupees. And if any insurance company has breached this provision, then the IRDA may cancel its license. And if the license of the insurance company has been cancelled by IRDA, then the company will not be able to run its operation in the market. And hence, this may cast significant doubt on the entity's ability to continue as going concern because the license has been cancelled by the IRDA, right? Next one is pending legal or regulatory proceedings against the entity that may, if successful, result in claims that the entity is unlikely to be able to satisfy. Now, what does it mean? We need to have a look at financial statements of X Limited again. This is the financial position of X Limited. And now let's assume X Limited has lost one case of income tax and there is demand of 2 crore rupees, which is required to be deposited to income tax department. Now, in this situation, when X Limited is already facing financial crisis, whether it would be able to repay 2 crore rupees, the answer is big no. And hence, this is the example. If the company is already facing financial crisis and if the entity has lost any litigation, then it would not be able for the company to deposit such demand with the authority, right? Next one is changes in law or regulation or government policy expected to adversely affect the entity. Let's assume I am running an entity in the state of Bihar and I am deal in sale of liquor. Now the Bihar government has banned the sale of liquor and hence I would not be able to sell the liquor in the Bihar government. So this is the example of changes in law or regulation or the government policy expected to adversely affect the entity. Now I am reiterating myself, as I have already said that these are only the indicators. I am not saying that the company will not be able definitely to continue its business. Uh, Rather, the company might have mitigation plan by implementing which the company might survive in the future, right? So if the mitigation plan is available with the company, then there is no issue. Only appropriate disclosure should be made in the financial statements. But if the mitigation plans are not available with the entity, then there is issue. Then there is going concern issue, which is required to be addressed appropriately in the financial statements as well as in the audit report. Now, what is the responsibility of the auditor? Auditor is responsible to obtain sufficient and appropriate audit evidence and conclude on the appropriateness of management's use of the going concern basis of accounting in the preparation of the financial statements. Based on the audit evidence obtained, to conclude whether any material uncertainty exists related to events or conditions that may cast significant doubt on the entity's ability to continue as going concern. Auditor shall remain alert throughout the audit for audit evidence on the entity's ability to continue as going concern and to disclose the facts in the auditor's report in accordance with this essay. So long story short, auditor is required to obtain the sufficient and appropriate audit evidence to conclude whether there is any material uncertainty or not, which may cast significant doubt on the entity's ability to continue as going concern. And if yes, then this fact should be disclosed in the audit report appropriately. Then what are the risk assessment procedures and related activities? Suppose you are planning to conduct the audit for financial year 2024-25 and you start your interim audit with effect from 1st of January 2025, let's assume. So this is the preliminary assessment stage. At this stage, the auditor will ask from the management whether you have assessed the going concern ability or not, going concern issue or not. So there could be two answers from management's end. First one is that yes, we have performed the assessment. Second one is that we have not performed the assessment. So if management says yes, if such an assessment has been performed, then auditor shall discuss the assessment with the management and determine whether management has identified events or conditions that individually or collectively may cast significant doubt on the entity's ability to continue as going concern. And if so, management's plan to address them. And it might also be possible that such an assessment has not yet been performed by the management. And in this particular scenario, the auditor shall discuss with the management the basis for the intended use of the going concern basis of accounting and inquire of the management whether events or conditions exist that individually or collectively may cast significant doubt on the entity's ability to continue as going concern. Again, long story short, auditor, if conducting the interim audit, will ask from the management whether the assessment regarding going concern issue has been performed by the management or not. If management says yes, we have performed the assessment, then auditor will ask again whether any events or conditions have been identified by you which may cast significant doubt on the entity's ability to continue as going concern. And if management says yes, then auditor will ask again, what are the mitigation plans available with you? It might also be possible that management says we have not yet performed assessment. In this case, auditor simply will ask what is the basis for the intended use for the preparation of the financial statements, right? Next one is evaluating management's assessment. So as I said, only and only management is responsible to make the assessment of the going concern. Auditor cannot perform auditor cannot assess going concern issue on behalf of the management. What is the responsibility of the auditor? Auditor is responsible only to evaluate the management's assessment of the entity's ability to going concern. Means auditor cannot assess going concern ability on behalf of the management. Auditor will only evaluate the assessment which has already been performed by the management regarding the going concern issue. If you talk about the assessment period, the same period auditor will cover that has been used by the management as per the applicable reporting framework, or the longer period if required by law or regulation. If the period is less than 12 months from the date of financial statements, then auditor shall request management to extend it to at least 12 months from that date. Why period of 12 months have been inserted in SA 570? There is logic behind this. Suppose there is XYZ Limited, which is preparing its financial statement for 31st March 2024. And many investors have invested in this organization, that is XYZ Limited. Now, while preparing the financial statements, management has disclosed that we are preparing the financial statements on going concern basis, right? But period is not mentioned, and you will see practically period is not mentioned in any of the financial statements regarding going concern. Simply, company mentions that we are preparing the financial statements on going concern basis, right? So suppose the company has mentioned that we are preparing the financial statements on going concern basis and period is not mentioned. Let's assume in the month of October, management liquidated the entity. Management has ceased the operation, correct? Now, investor will raise the question from the management, how can you do so? These facts have not been disclosed in the financial statements that you are going to shut down your business, you are going to seize your business in the month of November. Then management will give the answer that we have already mentioned that we are preparing our financial statements on going concern basis, and our going concern basis was 6 months. Then investors or the stakeholders will raise the question to auditor that why did you not disclose such facts in your audit report? Because you were the responsible to present the true and fair view of the financial statements, and this is not the true and fair view of the financial statements, because management was already having the intention to liquidate this business in the month of October, but such facts have not been disclosed in your audit report. Then auditor will say, sir, I am not responsible for making assessment on behalf of the management. I am only responsible to cover the same period as has been considered by the management, and hence there is no default at my end. Therefore, this clause was intentionally inserted in SA 570 that whenever any entity is preparing its financial statements, then period should be, then at least 12 months should be considered for the purpose of making going concern assessment, so that whenever you will prepare your next annual financial statements, you can clearly disclose whether we are a going concern entity or not. It might be possible that the company is preparing or the entity is preparing its financial statements for a period less than 6 months. Then auditor shall request management to extend it to at least 12 months from that date. And if management does not agree to extend its assessment period on the request of auditor, then auditor will report the same to TCWG, that is those charged with governance, as per the requirement of SA 260. Correct? Next point is that auditor is required to consider whether assessment includes, means management's assessment includes all relevant information of which auditor is aware as a result of audit. Now let me give you one practical example here. When I had been working in when I had been working at a CA firm in Ghaziabad, I did the audit of a client, and this client used to manufacture polythene bags in Ghaziabad. It used to manufacture and sell polythene bags in Ghaziabad. So when I had been conducting the audit of this client, DM of Ghaziabad issued an order that no one in Ghaziabad can sell polythene bags anymore, right? So I asked from the management, have you considered this notice while preparing your financial statements? Because now you cannot sell your polythene bags in Ghaziabad and hence you are not a going concern entity. So management told me that this order includes, or this order has banned only sale of polythene bags, but not the manufacturing of polythene bags. So what we will do, we will keep on manufacturing the polythene bags, but now onwards, we will sell these polythene bags in Faridabad, in Gurgaon, in Delhi, in Meerut. Means अपना शहर साफ रखेंगे, दूसरों का शहर गंदा करेंगे. Correct? Now let's extend this example. Suppose instead of DM, CM of UP state has issued this order, and now this order has the statement that no one in UP can manufacture or sell polythene bags in the UP state. Correct? I am reiterating myself. CM has issued the order that from now onwards, no one can manufacture and sell polythene bags in UP. Now, if I ask from the management, now what is your mitigation plan? Because now you cannot manufacture and sell polythene bags in Ghaziabad. So suppose management says to me, now what we will do, we will shut down this business, we will sell this plant, and we will set up a new plant in the state of Punjab, and we will deal in plastic products now onwards. Correct? Now we are not going to deal in polythene bags. From now onwards, we will deal in plastic products in the state of Punjab. Now you guys can see here clearly there is material uncertainty. It might be possible that while dealing in manufacturing, while dealing in plastic products, the entity might be able to survive in the business in the future, or company might not be able to survive in the future, and hence there is material uncertainty which should be clearly disclosed in the balance sheet as well as in the audit report. Correct? So these are the additional audit procedures whenever there is any event or conditions that have been identified by the auditor. So if events or conditions have been identified that may cast significant doubt on the entity's ability to continue as going concern, the auditor shall obtain sufficient appropriate audit evidence to determine whether or not a material uncertainty exists related to events or conditions that may cast significant doubt on the entity's ability to continue as going concern, through performing additional audit procedures, including consideration of mitigating factors. You need to check, you need to apply additional audit procedures to evaluate what are the mitigating factors available with the entity. So these procedures shall include determining the adequacy of support for any planned disposal of assets. So in my example, as I said, management was planning to sell its plant in Ghaziabad, and it was planning to set up a new plant in the state of Punjab. So whether there is any appropriate documents, supporting evidence are available with the management regarding the disposal of assets, auditor needs to determine. Then next is analyzing and discussing cash flow, profit, and other relevant forecast with the management. So as I said, auditor is required to evaluate whether the management will be able or would be able to survive in the business or not. Means if the management is planning to enter into a new business venture, in this particular case, auditor should evaluate what are the forecast of cash flows, what are the forecasts regarding profit, whether the management has done any technical or feasibility study or not, right? So all these factors are required to be considered by the auditor. Then next one is analyzing and discussing the entity's latest available interim financial statement. So if you are doing the interim audit, then you can review the interim financial statements of the entity. Then next one is reading minutes of the meeting for reference to financing difficulties. Obtaining and reviewing reports of regulatory actions. inquiring of the entity's legal counsel regarding the existence of litigations and claims. You should send the confirmation to the lawyers of the entity, whether what is to know what is the status of the litigations and claims against the entity, right? Next one is evaluating the entity's plans to deal with the unfilled customer orders. In last, confirming the existence, terms, and adequacy of borrowing facilities. So these are the just additional audit procedures which the auditor is required to perform it when the auditor gets to know that there are material uncertainties which may cast significant doubt on the entity's ability to continue as going concern. Then we need to check what is the implication on the auditor's report, right? But before directly jumping into the implications on auditor's report, we need to have a look at the different kinds of audit report, and we need to know that which report is issued by the auditor under which circumstances. So first one is SA 700, which deals with unqualified opinion. An unqualified opinion may be issued when financial statements are prepared in all material respect in accordance with the applicable reporting framework. Correct? If there is no error, if there is no material misstatement in the financial statements of the entity, then auditor may issue unqualified opinion. Rather, I should say auditor should issue unqualified opinion if the financial statements are free from error, right? Second one is SS 705, which deals with the qualified opinion. And this report may be issued if the financial statements are materially misstated or inability to obtain sufficient appropriate audit evidence. And the effect is material but not pervasive, means you have identified misstatements in the financial statements, and these misstatements are material but not pervasive. In this scenario, you may issue qualified opinion, right? Next one is adverse opinion. Financial statements are materially misstated and effect is material and pervasive both. So in this scenario, adverse opinion should be issued by the auditor. Next one is disclaimer of opinion. They are saying inability to obtain sufficient appropriate audit evidence and effect is material and pervasive both. Now please pay attention here. If you are not able to obtain the sufficient appropriate audit evidence, but effect is not pervasive, then you will issue qualified opinion. But if the effect is material and pervasive both, then in this scenario you will issue disclaimer of opinion. And last one is SS 706, which deals with EUM paragraph. It says auditor considers it necessary to draw the user's attention to a matter presented or disclosed in the financial statements. Means if any facts have already been disclosed in the financial statements and auditor wants to draw the attention of the users, then in this scenario EUM may be issued, right? It might be possible that the facts have not been disclosed in the financial statements, but still auditor wants to draw the attention of users, and in this case you should issue other matter paragraph instead of EUM, because EUM should be issued when and only when facts have already been disclosed in the financial statements. If the facts have not been disclosed in the financial statements, you cannot issue EUM paragraph. In this case, you should issue other matter paragraph in your audit report, right? Now we will discuss what is the impact of going concern in the audit report. This is example number 1. Suppose there is use of going concern assumption is appropriate, but material uncertainty exists. So auditor has concluded that going concern assumption is appropriate, but material uncertainty exists. Means either financial indicator or operating indicator or other indicators are there. In this scenario, auditor needs to check whether all these three items have been disclosed in the financial statements or not. What are these three items? First, events or conditions that may cast significant doubt on the entity's ability to continue as going concern, means whether it is financial indicator, operating indicator, or other indicator. These indicators must be clearly mentioned in the audit report. What is the exact event or condition that is casting doubt on the company's ability, on the entity's ability to continue as going concern? Second one, what is the action plan, what is the mitigation plan available with the entity? And third one, management may be unable to realize its assets and discharge its liabilities in the normal course of the business. If all these facts have already been disclosed in the financial statements, please listen to me very carefully. I am saying if all these facts have been presented in the financial statements, in that scenario, auditor will issue unmodified opinion, but material uncertainty paragraph must be there in the audit report. It might be possible that any of the fact is missing in the financial statements, or such facts have not been appropriately disclosed in the financial statements, correct? So if the facts have been inadequately disclosed or not disclosed, in this scenario, auditor will issue either qualified opinion or adverse opinion depending upon the circumstances, correct? So this is example number 1. Now we are going to discuss example number 2. Use of going concern assumption is inappropriate, means it has been concluded by the auditor that the company will not be able to survive in the business in future, and hence the company is not a going concern entity. If the company is not a going concern entity, but financial statements have been prepared on going concern basis, then irrespective of the fact whether appropriate disclosure has been made in the financial statements or not, auditor will always issue adverse opinion. Why? Because financial statements should have been prepared on liquidation basis as per the provisions of AS 24 or AS 105, right? But these financial statements have been prepared by the company on going concern basis, and hence wrong framework has been applied for the purpose of preparing the financial statements, and hence it becomes very important for the auditor, irrespective of the fact whether proper disclosure has been made or not in the financial statements, auditor should always issue adverse opinion in this case. Third, management prepares financial statements on liquidation basis. Now management itself is preparing its financial statement on liquidation basis, means management has agreed that we are not a going concern entity, right? So in this case, auditor needs to check whether the management gives in notes to accounts that the financial statements are prepared on liquidation basis and disclosed all the material facts affecting the financial statement, means proper disclosure has been made in the financial statements that we are not a going concern entity. In this case, auditor will issue unmodified opinion, but material uncertainty para must be there. Right? I hope I was able to explain all the implications on the auditor's report, right? Now, this is the illustrative format of the auditor's report to address the going concern issue. Suppose you guys have identified that the company is not a going concern company, any entity is not a going concern entity, or it might be possible that the entity is a going concern entity, but material uncertainty is there, means either financial indicators or operating indicators or other indicators are there in the organization. So how can you draft your audit report? So first example which I have taken, is regarding unmodified opinion, where the auditor has concluded that a material uncertainty exists and disclosure in the financial statement is adequate, means the company is a going concern entity or the entity is a going concern entity, but material uncertainty exists and proper disclosure has been made in the financial statements. So what the auditor can mention in the MU paragraph, and this is just the illustration, as I have said. We draw the attention to note number so and so in the financial statements, which indicates that the company incurred a net loss of INR so and so during the year ended 31st March 2024. And as of that date, the company's liabilities exceeded its total assets by INR so and so. So you guys can clearly say here, I am comparing the current liabilities with the total assets and not the total liabilities with the total assets, right? Further, as stated in note number this and this, these events or conditions along with other matters as set forth in note number so and so indicate that a material uncertainty exists that may cast significant doubt on the company's ability to continue as going concern. The promoters have sufficient net worth and have plans to invest in the business in future. This is the mitigation plan which is available with the company. Promoters are ready to finance the business of the entity, right? Management may be unable to realize its assets and discharge its liability in the normal course of business. So you can clearly see here the events or conditions which are casting doubt on the entity's ability to continue as going concern is there, mitigation plan is there, and realization of assets and liabilities in the normal course of business paragraph is there. So hence auditor may issue unqualified opinion, unmodified opinion, and whenever you are issuing any MU paragraph, you need to mention that our opinion is not modified in respect of this matter. Example number 2, qualified opinion. When the auditor has concluded that a material uncertainty exists and that the financial statements are materially misstated due to inadequate disclosure, means material uncertainty is there and proper disclosure has not. Hello, am I audible? Sagar, are you there?
Yes, Paras, I'm there. You're audible.
Hello?
Yeah, Paras, you are audible.
Hello? Sagar, are you there?
Yes, Paras. Paras, you are
Am I
audible.
audible?
Yes.
I can't hear you, Sagar. Am I audible?
Yes.
Okay. Just let me check what has happened. I can't hear you. Okay. Just wait for a second. Hello, am I audible?
Yes, Paras, you are audible.
Okay. Let me share my screen again. Is my screen visible?
Yes, it is.
Okay, thank you so much. Okay, so we were discussing regarding qualified opinion, right? When the auditor has concluded that a material uncertainty exists and the financial statements are materially misstated due to inadequate disclosure, means material uncertainty is there but proper disclosure has not been made in the financial statements. So what you can do in this case, you will issue the qualified opinion or the auditor will issue the qualified opinion, and in this para the auditor may mention. So I have taken the same example which I gave you regarding this manufacturing and sale of polythene bags. So due to order raised by the government, the company's business cannot continue due to significant fall in the sale of polythene bags. And the company does not have any alternative project to continue its business. This situation indicates a material uncertainty that may cast significant doubt on the company's ability to continue as going concern. The financial statements have been prepared on liquidation basis, and the financial statement do not disclose such facts. Means, as you can see here, the company is mentioning that no mitigation plan is available with the company, and hence the management itself has prepared its financial statement on liquidation basis. But what is issue here? Issue is that proper disclosure has not been made in the financial statement, and hence it becomes extremely important for the auditor to issue a qualified opinion in this case, right? Next one is adverse opinion. When the auditor has concluded that a material uncertainty exists and it is not disclosed in the financial statement. Due to order raised by the government, the company does not foresee future sales of the polythene bags, which was the single product of the company. Hence, it has planned to set up a new plant of plastic products in Punjab. So this is the same example, right, which I gave you. The company has not conducted the financial technical feasibility study with respect to the future demand in order to cover up the loss of sales of polythene bags. The note has failed to mention this significant fact, which indicates a material uncertainty that may cast significant doubt on the company's ability to continue as going concern. Therefore, it may be unable to realize its assets and discharge its liabilities in the normal course of business. The financial statements do not disclose such facts. So in this case, you can see here the company is planning to set up a new plant in the state of Punjab, but the company has not mentioned anything about the order raised by the UP government, right? No proper disclosure has been made in the financial statement, and hence, in this case, auditor will issue adverse opinion. Case number 5, again, it is for adverse opinion when the auditor has concluded that going concern is inappropriate and financial statements prepared on going concern basis. So this case we have already discussed. If the going concern issue is there, means the company is not a going concern company, the entity is not a going concern entity, but the financial statements have been prepared on going concern basis, then this financial statements cannot give the true and fair view, and hence in this case auditor will always issue adverse opinion irrespective of the fact whether the proper disclosure in the balance sheet has been made or not, because in this case there is no relevance of the disclosure. Why? Because this balance sheet, this financial statement should have been prepared on the liquidation basis, but what the management has done, management has prepared its financial statement on going concern basis, correct? And hence always adverse opinion is required to be issued in this case. Now what I have done, I have included few case studies which we may discuss. Case study number 1 is XYZ Limited is a manufacturer of televisions. Domestic market of specific products are not doing well, and therefore many entities in the business are switching to the exports. As per the audited financial statements for the year, the entity had net losses of 120 million. At the year end, its current assets aggregate to 1200 million and the current liability aggregate to 1500 million. So there is a working capital deficiency of 300 million. Why I'm saying there is a working capital deficiency? Because in this case study, current assets are being compared with the current liability, right? And hence there is a working capital deficiency because current liability is of 1500 million and the current assets is of 1200 million. Due to expected favorable change in the government policies for the electronic industry, the entity is projecting profits in the coming years. The shareholders of the entity have arranged alternative additional sources of finance for its expansion plans and to support its working capital needs in next 12 months. Now, what is the response here? So there is two material uncertainty. First one is regarding losses and second one is regarding working capital deficiency. And there are two mitigation factors. First one is the arrangement made by the shareholders to expand the business of the entity and providing working capital needs. And second one is change in the market. So this is the response which have been mentioned. Two factors that raises doubt about the entity's ability to continue as going concern are the net loss for the year amounting to 120 million, the working capital deficiency, that is current liability of 1500 million less current assets of 1200 million, that is 300 million existing at the balance sheet date. One more point I wanted to highlight here: if there is loss in the financial statement, it doesn't mean that there will be always going concern issue. It might be possible that the company has incurred loss in 1 year and the company will improve its situation in the second year. Moreover, you need to always check whether the net worth of the company has been eroded or not. If the reserve and surplus are positive, net worth is positive, then as per my view, there is no going concern issue, right? Now, it depends on the auditor to auditor. It is a matter of professional judgment. It is subjective matter. But if the financial statements, or you can say the net worth of the entity has not been eroded, there is loss only in a single year, then it doesn't mean that the financial statement should not be prepared on the going concern basis, or the company should mention that material uncertainty exists. It doesn't exist. If the net worth is positive, if the total assets are positive, means the current liability is not exceeding the total assets, right? Second point, further the case study is saying, however, there are two mitigating factors. Just give me a second. However, there are two mitigating factors available with the entity. First one is that the arrangements made by the shareholders to fund the entity's expansion and working capital needs and projected future profitability due to expected favorable changes in the government policies for the industry the entity is operating in. If the auditor is of the view, based on available evidence, including reasonability of the future profitability, that there is a material uncertainty related to going concern for at least next 12 months, there is need to include section on material uncertainty related to going concern. Means MU paragraph must be there in the audit report if the auditor has concluded that material uncertainty exists. However, it is recommended that to include a suitable note in the financial statements. Means all the three facts which we have already discussed. First one is that entity entity sorry, the events or conditions which may cast significant doubt on entity's ability to continue as going concern must be mentioned in the notes to accounts. Mitigation plans must be mentioned in the notes to accounts, and this line that the company may not be able to realize its assets and discharge its current liability in the normal course of business. These three disclosures must be there in the balance sheet, must be there in the financial statements. Only then you can issue unmodified opinion, including material uncertainty paragraph in your audit report. If the disclosure has not been made properly, then we have already discussed that we need to modify our report accordingly, right? This is case study number 2. Here, the facts are: a company is an exclusive seller in the country for retail sale of imported branded garments and was set up 2 years ago, having share capital of 1 lakh, has unsecured loan of 200 lakhs and accumulated losses of 50 lakh rupees. Correct? The unsecured loan has been granted by the promoter of the company along with his family. The company is having negative net worth and negative working capital, right? So material uncertainty is there because the net worth of the company has already been eroded and there is working capital deficiency as well. The promoters have sufficient net worth and have plans to invest in the business in future. How should the auditor gather sufficient and appropriate audit evidence to conclude on the appropriateness of the going concern basis of accounting? We can read the response now. The auditor should obtain the auditor should obtain and review management's assessment of going concern basis of accounting, which includes cash flow projections, detailed business plan covering the period of assessment, and support for the entity's ability to obtain new funding. So as we discussed, whenever there is material uncertainty, auditor needs to perform additional audit procedures. Auditors needs to check what would be the cash flow projections, how the company is going to mitigate its material uncertainty, whether the company is going to set up a new plant, whether the company is going to raise the fund from the market, whether the company is going to raise fund from the promoters, what is the mitigation plan available with the entity. So auditor needs to perform additional audit procedures whenever there is material uncertainty in the entity. Then auditor may obtain a support letter from the promoter for the financial support for at least next 12 months. In case of support letter, the auditor should assess the intent and capability of promoters to provide the financial support, right? So what auditor should do? Again, auditor needs to perform additional procedures here. If the promoter of the organization is saying that I am ready to provide fund to the organization, then auditor should take a support letter from the promoter. Means it's obviously it should be in writing. Why? Because auditor needs to put this document in its software for the purpose of documentation, right? And auditor also needs to check what is the intention and capability of the promoters, whether the promoter is going to fund actually or not, and whether the promoter is capable of for providing the finance to the organization or not, correct? So auditor needs to check the net worth of the promoters as well. Suppose it might be possible that the promoter may say I'll provide 50 crore rupees to the organization to expand its business or to mitigate the working capital requirement, right? But the net worth of the promoter is already 10 crore rupees. Now in this case, how any promoter can say I will provide the finance of 50 crore rupees in spite of the fact that he is having the net worth of 10 crore rupees, right? So professional skepticism is required to be applied here. Auditor needs to check what is the exact intention and what is the capability of the promoter, whether he is capable enough to provide the finance or not to the organization. Correct? However, in the present circumstances, material uncertainty exists. Accordingly, the financial statements should include adequate disclosures, including availability of the financial support from the promoters. The auditors should report under a separate paragraph material uncertainty related to going concern if the adequate disclosures have been given in the financial statements. Now, what could be the format of this support letter? Let me share with you. Just give me a second. Please let me know. Is my screen visible? Okay. So this is the illustrative format of support letter which has been prescribed, which has been given by the institute itself. I have taken it from the implementation guide to SF 570. So if you will read this support letter, it is clearly mentioning that this support letter is being provided by parent company to its subsidiary company. It means subsidiary company is facing financial crisis. Financial indicators are there in the subsidiary company, and hence this letter is being obtained by the subsidiary company from the parent company. So this letter should be issued or will be issued by the parent company on its letterhead, and it is mentioning that this is the letter of support for financial assistance to ABC Limited for ongoing projects and operations, right? And ABC Limited is a subsidiary company of XYZ Limited here. V means ABC Limited. Sorry, V XYZ Limited, the parent company, confirms that we will provide financial support to ABC Limited in order to meet the shortfall in its fund requirements over banks and other borrowings to meet out of the projects which are in the progress, and other liabilities including loans from other group companies, if any, for a period not less than 12 months from the date of financial closure of the accounts of the company for the year ended March 31st, so and so. So you can clearly see here the holding company is ready to provide fund to its subsidiary company for the purpose of meeting the working capital requirement, for the purpose of long-term projects as well, and for the purpose of repayment of loan from other group companies. And this support will be provided by the holding company to subsidiary company for a period which is not less than 12 months. This we have already discussed, that going concern assumption is required to be made for a period for at least 12 months, and hence it is mentioned that support will be provided for a period of not less than 12 months. This letter is being issued at the request of ABC Limited in respect of support for the closure of their audit for the financial year ended so and so. This is done. So this is done from my side, Sagar. That's all I wanted to say, and over to you regarding the question answer round.
Thank you so much, Mr. Vadas. This was wonderful and insightful session. Um, so while you were explaining all the nitty-gritties of this complex topic concepts, I had noted down a couple of questions for you.
Mhm.
Uh, so one is like, what are the common challenges that as an auditor we face while assessing the maturity level, especially when there are certain complex items or the items have some judgment involved. What should, what are the challenges and what should be our approach for it?
Okay. So first of all, you need to calculate the overall materiality, performance materiality, and CTT level as we have already discussed. Now, it might be possible that there are few captions in the financial statements which are prone to risk, which are having high risk. And in this case, I would suggest personally that you should apply substantive audit procedures, irrespective of fact whether this is crossing your threshold limit or not, because these are the high risk areas, and hence substantive audit procedures should be applied, or rather I should say must be applied, instead of applying the analytical procedures. So it depends on the professional judgment of the auditor. As I said, this is very subjective matter. I cannot conclude that these are the areas which must be checked and these are the areas which should not be checked, or these are the areas on which substantive audit procedures must be applied and these are the areas on which analytical procedures must be applied. So it depends on the nature of the organization, size of the organization, and the nature of the audit as well, correct? So there might be few areas which require attention of the auditor, and irrespective of the threshold limit set by the auditor, these areas must be checked in full detail.
Great, great. Thank you so much. The second question I had on materiality is, do we have some different concept for multi-location units where maybe, let's say, a company's have a diversified portfolio.
Correct.
One is into, let's say, garment, and another is into apparel, something like that.
Right.
And so, is the materiality level defined differently, or maybe from location perspective or from a business perspective?
Yes. So you can calculate your materiality on segment wise as well, and even for location wise as well. Suppose there is a subsidiary, there is a holding company, and there are multiple subsidiary companies of this holding company, right? Now
Mm-hmm.
let's assume the size of holding company is very big. The turnover of this holding company, let's assume, is 10,000 crore rupees. Net worth is 500 crore rupees. Profit is, let's assume, 100 crore rupees. And there are multiple subsidiaries of this holding company, correct? If one of these subsidiary companies having the turnover of, let's assume, 2 crore rupees, profit is 50 lakh rupees, net worth is, let's assume, 25 lakh rupees, then materiality is not required to be applied in this case. Means, in the case while you are conducting the audit of subsidiary company, I say, if uh, all the things go wrong in the subsidiary company, then also auditor is not required to modify its audit report. Why? Because it could not be material for the auditor as a whole. But if there are separate auditors, there are joint auditors or there are separate auditors, subsidiary companies being audited by another auditor, holding companies being audited by another auditor, then the auditor of subsidiary company may apply the calculation of materiality, which we have already discussed, right? So again, it is a subjective matter. It depends on the nature of the organization and the entity which is under audit.
Got it. Got it. And while arriving at the materiality level, what are the quality factors that also we should consider? Because uh, I understand that materiality level is basically complete. It's a quantitative factor where we see the assets, we see the turnover or the profit of the company. But what are the other quality factors that also affect the materiality level?
Okay, so I have already given two examples here. I am reiterating. Suppose if there is requirement of any accounting standard or Indian accounting standard that
Mhm.
any particular disclosure must be made in the financial statements, right? For example, as per NDS 19, actuarial table is required to be presented in the financial statements. If the company has forgotten to made the disclosure, if the company has forgotten to disclose such table in the financial statements, then instead of considering the quantitative factor, you should consider the qualitative factor, because here is breach of NDS 19. You are contravening the section, you are contravening NDS 19, and hence in this case qualitative disclosure is required to be considered. Again, suppose we are discussing the concept of going concern. If the entity is not a going concern entity, in this particular case you are not required to check whether it is crossing the threshold limit set by the auditor or not. If the entity is not a going concern entity, it must be reported in the financial statements, right? Such facts must be disclosed in the financial statements, irrespective of the fact whether it is whether it is exceeding the threshold limit set by the auditor or not. So when there is requirement of any NDS or AS or any authority to disclose few facts in the financial statements, then such facts must be disclosed. For example, we can discuss one more example. MSME disclosure in respect of trade payable is required to be disclosed in the financial statements, right? If such disclosure is missing, then the audit report is required to be modified in respect of only such item, right? So these are the examples of qualitative materiality where auditor should not consider the threshold limit set by the auditor.
Okay. And I believe this will also apply to the non-financial data. Like recently, there was a requirement by SEBI to for top 10 1,000 listed company to have ESG related disclosure. So, if as an auditor, will apply the same logic for non-financial.
Absolutely, absolutely.
Okay. With respect to going concern, so it's a management responsibility to conduct to perform
Assess
or
the
the
going
have
concern issue, right?
correct. So what is the what sort of document that we expect from that, or what sort of analysis? So is there something checklist based, that what are the maybe qualitative or quantitative parameters that they have factored in their assessment for going concern, or is there any different form or format of the document that we look into?
So there is no as such prescribed document. You need to evaluate the situation, and according you will have to document for yourself to form an opinion whether going concern issue is there or not. We have discussed the examples of financial indicators, we have discussed the examples of operating indicators, we have discussed the example of other indicators. Suppose there is a litigation going on against the company, then in this case auditor may send the confirmation letter to or the status letter to the lawyer of the organization to know about the status of the litigation, whether it is going against the entity, whether it is not going to against the entity. So as such there is no prescribed checklist which you may take. So what you need to do, you need to analyze what is the situation, and according to which you need to obtain the audit evidence for the purpose of forming an audit report on audit opinion on the financial statements.
Got it. Um, I have one last question on going concern. So, in you took very good example of that plastic industry. So just let's say there is a going concern where they have to shut down their manufacturing plant in one state and have to go to another state.
Right.
Now, where we as an auditor are not aligned with the or do not have are not getting the reliance on the ongoing mitigation plan that the management is providing.
Correct.
How should we approach or resolve this disagreement? I understand that if there's the disagreement persists, this will eventually go as will be reported in our audit report
Absolutely correct.
based on qualified or whatever
Based on the
the
documents available with the auditor.
correct. So, but that will be our last step. So, what should be the how should we resolve the conflicts, or how should we communicate?
So if the management says that we are the going concern entity and these are the mitigations plans available with us. So first of all, auditor is required to perform additional audit procedures, which we have already discussed. And if management is, if the auditor is not satisfied with the documents or with the answer of management, then as per SA 260, auditor should discuss the same with those charged with governance, right? And if the auditor is still unsatisfied, or the auditor has not reached to at a stage where it has obtained the sufficient audit evidence to conclude whether uncertainty material uncertainty paragraph exists or not, so in this case either auditor may issue disclaimer of opinion, because the auditor is not able to gather the sufficient information on the basis of which the auditor may form an opinion, or if the disclaimer of opinion cannot be issued, then audit report must be modified. Now it could be qualified opinion, it could be in the form of paragraph, it could be in the form of paragraph, it depends on the facts.
Got it. Thank you so much, CA Paras. This was very insightful, and there were a lot of takeaways from this wonderful
Thank you so
webinar.
much.
I pass on the baton to Anil ji.
Thank you, sir. Thank you. Can you hear me?
Yes.
Yes.
Thank you so much, Paras ji, for such a detailed and wonderful deliberation. You have explained all the concepts relating to the going concern and materiality, as well as justified with your presentation. And moderator has also raised certain questions, and you have given your insights relating to those questions. So, on behalf of AASP of ICI, I extend the heartiest thanks towards both the moderator as well as speaker for their
Thank you so much, sir.
precious time
Thank you so much,
and
sir.
sharing your insights with all our esteemed members. Thank you so much, Paras ji. Thank you so much, Sagar ji, for such a wonderful
One more
presentation.
point I want to highlight here, sir. If there is still any query which the participants wants to discuss, so this is my number. They can call me anytime and we can discuss over call if there is any query.
Thank you, sir. Thank you so much, Paras. Thank you so much.
Thank you so much,
Thank you
sir.
all the
Bye.
participants of today's session. Thank you. Thank you.
Thank you.
Thanks. Bye.